All right, guys, let's get this presentation started. This is a replay of a presentation we gave for our Lunch and Learn back in January called Uncertainty is Certain. And we're going to cover a lot of fun things today. My name is David Zarling. I'm a chartered market technician. I'm also a partner and head of investment strategy and research at Client First Tax and Wealth Advisors. For our clients, we use the Adaptive Investment Management System. Like I said, we've got a lot of fun things to cover today, but first things first, as always, these types of presentations are for informational, educational purposes only. You may be listening to this or watching this, and we don't know you personally, so we don't know your personal financial situation. So for you, you shouldn't be using this as some type of basis for investment decisions. There's additional legal restrictions in terms of use regarding this video. You can check those out online. But I always like to start with a little bit of a story. Recently, my brother, Justin, and myself had the opportunity to go scuba diving, get certified, and learn a little bit about that. A fantastic experience. It ties into what we're going to talk about today, whether it's using the right tools to identify where you are in the market or what the environment of the market is like, but also risk management tools to make sure you're being safe. And so we're going to cover some of those things today. This was just a fun experience for me. I wanted to share it. Sometimes the water above can be turbulent, but the water down below is still beautiful. And we're able to see God's creation in another fashion. So it was a fantastic experience. But let's jump into this presentation and cover the different topics. We're going to talk a little bit about seasonality, Santa Claus rally, and the power of January. We're going to look at 2020 historical year of market extremes. Ian's actually going to jump in here during a live presentation. I would introduce him, but in this instance, we're going to splice him in. He's going to join in this presentation. We'll get his information on here as well. Then we're going to talk about how the adaptive system handles such market extremes, because 2020 was an incredibly historic year from a market extreme perspective. Then we'll have a Q&A panel discussion that Paul's going to join us. He'll ask some good questions, and we'll provide the best answers we can. And then we'll have some housekeeping and final thoughts. So jumping right in, Santa Claus rally. It's the last 5 trading days of December, plus the first 2 trading days of January. This is really something that was found by Stock Traders Almanac, Yale Hirsch, and the quote, "If Santa should fail to call, bears may come to Broad and Wall," right? Wall Street's located on the corner of Broad Street and Wall Street. And this 7-day period, so the last 5 trading days of a year and the first 2 of a year, the subsequent year, has an average return of 1.3%. That's since 1969. There was a 1.7% average gain since 1928. All good and great. Really what we want to be looking at in this period is not when it's positive, it's really when it's negative that it has an impact. So according to Stock Traders Almanac, when it failed to show, when we failed to have some type of positive return during those 7 days, it's happened 6 times since 1964. It didn't rally. Of those, we saw 3 flat years, so 1994, 2004, and 2015, 2 very nasty bear markets, 2000 and 2008, and a mild bear that didn't end until February of 2016. So it can be a warning of lower prices ahead when this period of time does not have a positive return. It's not a guarantee. We know that there's no such thing as a guarantee of future returns, but it's seasonal information. In this Santa Claus rally period, the last 5 days of 2020 plus the first 2 trading days of 2021, S&P had a positive almost % return. So it's nice to see that from a seasonality perspective. Then when we look at the power of January and what those things bring, and again, some of this is correlation. It doesn't mean causation, but it does show implication. Seasonality is important. We want to pay attention to it. And it's not more about trying to guarantee what the future brings, but seasonality is more about when something doesn't happen. So if something historically has a positive seasonal tendency and the market doesn't do that, that's when that's pretty good information as far as what type of environment we're in. So the first 5 days of January have significance. 37 out of the last 43 years when the first 5 days of the year are up, the average gain for the S&P for the full year was roughly 15%. And then when the first 5 days are down, it's a little bit more like a coin flip. S&P 500 generates about a 0.2% annual return. So that it's less reliable when the first 5 days are down. When the first 5 days are up, that tends to be a positive sign, positive seasonality for the year ahead. And so for the first 5 days in January, it was up 1.8. The S&P 500 was up 1.83%. When we look at January as a whole for the month, that has some pretty strong seasonal tendencies. So when we look back to 1950, every down January, and there was only one exception to this, 2016, if January was down, it preceded a flat market, some type of 10% correction, or extended bear market. So in 2016, that didn't happen, but the other years since 1950 that it did, the rest of the year followed with an average loss of almost 14%. Again, we're dealing with averages, but it makes sense, right? If the start of the year is weak, it may be preceding further weakness in the market. We know that markets have a tendency to have momentum with them. So a negative January would, it makes sense on why that would be precede those type of environments. Again, seasonal information, not a guarantee of future returns. Now, when the S&P 500 is positive, it also, kind of suggests that maybe the rest of the year, 90% of the time since 1950, when January records a positive return, the year finishes positive as well. So it's pretty accurate, pretty incredible. Again, not a guarantee, but when January is positive, that tends to be a nice bellwether for what the remainder of the year looks like. In this year, I should point out the trifecta, right? So when we talked about the Santa Claus rally, first 5 days, January barometer, when all three of these are positive, the full year return was positive 27 times. So 93% of the time with an average gain of almost 18%. So pretty impressive when all three hit. So we had the Santa Claus rally hit. We had the first 5 days hit, but for January 2021, the month finished negative. Actually happened in the last week. We had a nice start to the month. Last week of January was pretty normal as far as corrections go. I don't want to make it sound any more alarming at all, but January was negative. Does that mean we have a period of weakness in the year to come that could be 10% or greater? We wouldn't be able to be surprised by that from a seasonal perspective, but it's not a guarantee. But we had 2 out of the 3. We had a positive Santa Claus rally, positive first 5 days, a negative January, which can precede additional weakness in the market. We'll see. I mean, February so far has been pretty good. There's been a few weekdays, but February's been a pretty good start. This is being recorded on the 18th of February. So we will see. In the end, as we always talk about, price is what matters most. All these seasonal data points are nice to look at. They give us some perspective on the environment and what to expect. We've talked on the podcast before about how February is the month that has the most negative seasonality. So there's in the 6-month period. So there's a positive 6-month period that runs from November through April. That tends to be the strongest 6-month period in a 12-month time frame. Are those 6 months. In that 6 months, February is the weakest. In post-election years, which we're in, February is even more weak. So it'll be interesting to see how we finish out February as well. So hopefully that explanation, I didn't butcher that too bad, and that makes sense, but we'll be paying attention to February seasonality as well. Now I'm going to introduce Ian McMillan. He's our market technician with us. You've probably heard him on the podcast, but he's going to go ahead and talk about some market extremes that we saw this year. Thanks, Ian.
Hello, my name is Ian McMillan. I am a market technician here with Adaptive. And today I'm going to talk to you about all of the extremes we saw in 2020. I know Obviously, the big talk of the year was the correction during March, and for years and years, that will most likely be the big topic that comes out of 2020. But there were actually also lots of other extremes throughout the year as well. So let's take some time to get into this. Again, 2020 was a year of extremes. I picked this picture of a skydiver. No, that is not me. But I thought this was a pretty extreme example of how a lot of 2020 felt. So first and foremost, let's talk about the CBOE Volatility Index. For those of you who may not be familiar, this is an index that simply gives us the volatility of the S&P 500. It's based on options on the index, puts and calls, and kind of gives us a idea of what types of daily moves we can expect from the broad markets. Now, the general rule of thumb here is to divide VIX by 16, and that will give you a percentage move. So as you can see back here, if it's around 80, then we're expecting roughly a 5% intraday move on the S&P. In March, we actually did surpass the VIX high from October 2008. While markets did not bottom in October 2008, markets actually bottomed in March 2009. October was when we saw the highs for the VIX during the great financial crisis. However, in 2020, the VIX and stocks both did bottom in late March. So that was kind of one of the main differences. And we've still not gotten back below 2020. Kind of tends to be a safe zone, or viewed as a safe zone. Below 20, stocks can usually trend higher without too much anxiousness. So when we see VIX get back below 20, that's kind of our golden area. This is another visual representation that I think gives a great view of really the types of daily price swings we saw in March compared to what you would typically see. So going back to late December all the way through late February, pretty typical. You see some, 0.5% to maybe 1% up days. Kind of the same on the bottom, a couple 1% down days, but this is really a pretty normal, healthy trending market. And then as you see, we get into late February, things start to get really wonky. And then into March, just really massive moves in both directions, 5, 10, even 12%. So definitely out of the norm, not a normal environment. And it changed very quickly. Really on that February 25th gap down, if you guys go back and look at the chart, that was really when the wild and wide percent swings started occurring. And they went on for, almost exactly a month. So circuit breakers. Some of you may be aware that the major indices have circuit breakers on them, both to the downside and the upside. There's 3 different levels. The first is 7% to the downside, then 10, and then 15, I believe. Don't hold me to that, but I do believe those are the 3 levels. So markets are down, let's say the S&P is down 5%, they will halt the market and stop trading. and for about 15 minutes. As you see here, we actually got multiple circuit breakers in March. So again, a very, very rare occurrence, and really all of them happening within a 2-week span. We actually ended up getting a circuit breaker to the upside back in November on the Russell 2000, which I believe may be 7% to the upside, but again, it could be 5, it might have been 7, don't hold me to that. But I know we did go in November, so they do happen to the upside, but March, definitely some downside circuit breakers where we were at 9:30 Eastern opening bell. Stocks were halted. Very crazy. Oil futures. This might have been one of my favorite, looking back on it, my favorite moments from 2020, late April. I actually didn't even know this was possible, and I bet if you surveyed most professionals, they would have also told you they didn't realize this was possible. But oil futures actually went to intraday negative $40. So pretty crazy. Now, I believe that was for a 1-month forward contract. So in April, these were for May deliveries. Now, you say, oh, oil is $40. Could I have gone to my local Quick Trip? Would they have paid me to take gas off their hands and fill up my truck? No, that's not how it works. I know in theory that's would seem to make sense, but they were not giving away gas, to the end user. But had you showed up in Cushing to take physical delivery of that gas in late April, they would have done so. Absolutely crazy. Again, I had no idea oil, crude, one of the most consumed resources and commodities on this planet, could actually reach negative $40. What an insane day. Growth versus value. This is one of the relationships. If you listen to the podcast or taken anything that Dave or I or the adaptive team does on Twitter, growth versus value is one of the relationships by far that we talk about the most. And this really crazy run, we've seen this starting in 2017, but during the March correction and for a few months after, some really crazy spreads and behavior between these two large areas of the market, which I would say the market's pretty much split 50-50 between growth and value. Again, we know growth stocks is tech, discretionary, some parts of healthcare like biotech. Value tends to be more financials, energy, materials. So from March 27th, a couple days after the big drawdown started, all the way through the bottom, about 57 days, or I'm sorry, through May 23rd, so about 57 days, large cap growth outperformed small cap value by 44%. Again, we know small caps have been horrible for years. This seems to have been really an extreme part of that relationship where it really went into overdrive. Almost the exact opposite that we saw coming out of the dot-com bubble. So back in 2001, January 8th, all the way through September, 164 days, almost three times as many days. Small cap value actually performed large cap growth by 45%. So roughly the same type of spread between performance, yet in 2020, this happened in just 57 days. Another example of growth versus value, we'll take two of those sectors I mentioned, tech versus energy. Tech has been the strongest area of growth. Energy has been the weakest area of value. So you can get both extremes here. Again, between February and November, 181 days, tech outperformed energy by 131%. That's pretty crazy to see in roughly a 8 to 9 month span. And again, we saw the exact opposite back in 2001. 263 trading days, so almost a full year. Energy outperformed tech by 68%. So about half of what we saw it underperform by this year or last year in 2020, and in less time. So again, just extreme spreads. And just goes to show you that if you can avoid the right areas, it can really do almost as much good for your portfolio as being, or if you can avoid the bad areas, it can do almost as much good for your portfolio as being in the right areas. Put call ratio, another extreme on both ends that we saw in 2020. You can see 2020, that big spike up to almost 1.30. This means they were buying 1.3 puts for every call that they were buying. Puts are contracts to bet against an asset declining. Calls the opposite. You want to bet on the future value of an asset being greater than it is at the current time. So we saw the put call ratio get very high. We've also seen it hit historical lows. While it did not hit a daily low in 2020, although it is close to these levels we saw in 04, 2010, 2014. On a monthly basis, to get rid of some of that noise, we'll make this a little larger. We did see a pretty remarkable, if you want to call it a monthly closing level on the put call ratio. So definitely extremes there, very bullish. Someone say this is a contrarian indicator. I am not one to quite buy into that yet. People want to own stocks. I would say that this indicator works better as a contrarian indicator on the downside. When you see it get too high, it's usually when stocks are going to, or when you see the ratio get too high, usually stocks are close to ending their downtrend and will resume higher themselves. When it gets too low, those types of environments can really go on for a while. I don't think that there's much there to say people are too busy or are too bullish. It kind of just is what it is. So November price thrusts. Two huge moves. And again, this is rare to see at all-time highs, but both the Russell 2000, we know there's a small cap index, US stocks, had its best month ever, 18% in November. Huge monthly candle. And we saw it at all-time highs. Very, very interesting. And the same with stocks around the world. It wasn't just here in America. If we use the ACWI, the MSCI ACWI, also having its best month ever in November at all-time highs. Some could categorize this as a blow off top. And I think I speak for David here as well, not so convinced that that is the case we have here. And with that, that is my presentation for today. I'm going to hand it back to Dave. I hope this was educational, and we'll see you in April.
Thank you, Ian, for highlighting those impressive extremes from 2020. And I can tell you pretty confidently that economic textbooks, stock market classes in college, you name it, 2020 is going to go down in history books as a year with just tremendous volatility, tremendous extremes that we've never seen in markets before. You know, we talked about the February, March correction, how fast it was, being one of the fastest in history from a new high to something greater than a 20% correction, with that period being down minus 35%. Then the fastest recovery on record. 2020 was just an incredible year from market extremes. And what I kind of wanted to touch base on here is just how the adaptive system navigated that scenario, which gives us a good tell on how does a system function, right? How does the system adapt to different market environments? Because that's the point. And so here's the S&P 500. This is for illustrative purposes only. Each of these, if you're not familiar with them, represent a candle, each candle represents a day in the market and what's going on with price. We have February 19th marking a high in the market. You can see our allocations on February 20th, how exposed we are. In the yellowish orange color is exposure to stocks. And I will say, to clarify, we were actually some of this, the way this pie is designed and looks, blue is bond exposure, orange yellow is the equity exposure. However, this doesn't reflect that. This pie makes it look like Ultra Growth, for example, was less than 100% allocated to equities. That's not true. It was actually with the appropriate use of leverage. We were actually had a increased exposure to stocks at this point. We were about 120% long. You could see as we go along, however, that we're trimming, right? Each of our models starts trimming as the price corrects. We break certain levels. We use those price levels to dictate how much exposure we're going to have. That's our adaptive process. We're going to plan, right? We're not going to predict what the market's going to do. We're going to have a plan for what the market actually does. And so you could see us even by February 21st, we're paring back, we're decelerating or hitting the brakes, tapping the brakes on our exposure, because from about October of 2019 through this February, what we now know is a peak, didn't know it at the time, we were pretty aggressively long for our clients, and it paid off. But by March 6th, we had dramatically reduced exposure. In fact, Ultra Growth, our most aggressive portfolio by March 6th, is net neutral. And what I mean by that is you can see there's an equity piece here, but I will tell you that equity piece was half and half, long and short. So it was net neutral with a bond position, and bonds were actually rising at this point. That quickly changes as we move along in March, where they start selling everything. But you could see we're greatly reduced exposure, even net neutral, or even having a slight short position in something like Ultra Growth. We avoid March 9th, and you could see our equity exposure at that point, basically no exposure as the correction unfolds. So that shows you just how quickly adapting to different market extremes can happen by using a pre-planned approach based on price levels, based on supply and demand, right? That's economic law. That's not theory. More supply than demand, price drops. More demand than supply, price rises. That's economic law. And so that's what our process is going to be based off of, is economic law, not opinions, not theories, because we view that all opinions, whether they're good opinions or not, are reflected in price. And so here you can see how we scaled out of the market, protected our clients. An example of this would be the market corrected during this period from the high to what we now know is the low, minus 35%. Our most aggressive portfolio, Ultra Growth, was down about minus 17, with our most conservative only being down about minus 7. So that gives you an idea of the type of protective measures we're taking in these models as an extreme event, right? This is one of the quickest corrections ever recorded, how we were able to navigate that. On the flip side, coming out of this, by April 6th, I mean, we start having some exposure, slight exposure, late March, but by April 6th, we start scaling back in more aggressively. These charts show how much equity exposure we're taking on by certain periods of time. Now, there's changes in between here, but we just highlighted a few dates. Even being aggressively long going into June, there's a corrective period in June and July. Been very aggressive, staying involved, scaling back into the market when it was appropriate. Again, it was all about reclaiming important price levels. Whether it was something like 2640 or a level like 2640 back in early April. That was an important level for us. Scaling back in at that important time, being involved, not hyper aggressive, but as things unfolded, increasing exposure, stepping on the gas a little bit. Because again, back in May, this was a period of time where many in the professional industry were expecting the market to roll back over. It didn't. We stayed participating based on price, not based on just whims or guesses or any types of thing like that. We use price to plan, and as long as we're above certain price levels, we're going to be involved. And if it's below, we're not. And so that's kind of our process. And so I wanted to show this, try to be transparent with how we think about things, how we increase exposure as corrections and their rebounds unfold. One of the blessings I think about in 2020 is that the market did rebound the way it did. A couple things there. Markets are a future discounting mechanism. So they give you an idea of what the market thinks about economies, companies, societies 6 to 12 months in the future. And the fact that we rebounded as quickly as we did after a panic crash was important information, because it was telling us that COVID was not this global killer that everyone thought. Originally, they were thinking this was going to be like extremely bad. I don't want to downplay it and say it wasn't bad, but it's not the pandemic that they talked about at the beginning, where if you would have known multiple people by this time who would have succumbed to COVID. And that's not the case. Mathematically, we did not have the compounding of death rate that you typically see with a major pandemic. Again, not trying to downplay what COVID is, but the market was showing us that COVID was not as bad as initially thought. So this chart here shows you, basically different size accounts, $1 million account, $500,000, 250. You can find yourself in here and just kind of give you a feeling of what would it have looked like to experience the February, March crash using, for example, just being invested 100% in something like SPY, right? A $1 million account would have been around $660,000 by the end of March. Wouldn't feel too good. 60-40 portfolio, 60% stocks, 40% bonds would have been around 775. Still not feeling great. Our most aggressive portfolio, which in uptrends is trying to beat the S&P 500, frankly. I don't know many places that say that out loud, but that's the goal of ultra growth. And here we are having less drawdown than something like a 60-40 portfolio. And so this chart does a really good job highlighting the protective nature. That's the main feature of adaptive, is the aim or goal of reducing drawdown, which is really important for every age, but especially when it ties into how we do financial planning with our true holistic planning, right? You can't have your account cut in half and have a bona fide financial plan. That's why we manage adaptively. So this chart gives you a good highlight. Hopefully I have had it up here long enough. You can even hit the pause button and look how it would have affected you. But I think it does do a good job highlighting. So these hypothetical returns do a good job highlighting the difference between being adaptive versus 100% allocation or a 60-40 portfolio, which is pretty common. So at this point, I'm going to have Paul join us. He's going to ask Ian and I some questions, and we'll do our best to provide some answers. So thanks, Paul, for joining us. Take it from here.
Hello, everyone, and welcome to the question and answer panel. I'm Paul Zarling, the managing partner at Client First, and we're happy you could join us for this section of the presentation. I've got David Zarling and Ian McMillan with me, both chartered market technicians. Really appreciate you guys. And I know you've covered a lot of data at this point, some charts and some insights for our clients, but I thought I'd take a moment while we've looked back in other parts of the presentation, I want to kind of look forward a little bit. So I've got a couple questions I want to ask you guys, and then we'll insert some questions that we've got from the crowd in the past, and we'll add that as well.
That sounds fantastic.
All right, wonderful. So Ian, Dave, looking forward, there's a new person in the White House. Inauguration as of this recording was yesterday. Looking for the next 6 to 12 months, what does it mean to have Joe Biden in the office, and what does it mean for the markets?
I'll take this one. And the truth is, as we have shared before, in fact, there's a good slide here that Dave shared at the last Lunch and Learn in October. When we look back over decades and decades of market returns and who was president then and what party they were associated with, there's really no advantage to either party. I know lots of people have very strong feelings about what Biden means or does not mean for the economy or for stocks, or what certain sectors or industries will perform better or worse during a Biden administration. I have absolutely no idea what his administration or presidency means for stocks. I don't even know what it means for stocks next week. So I certainly don't know what the next 4 years has in store. We will just let the data and the trends tell us.
Mm-hmm.
Yeah, that's exactly right. I think for us, same as it was in 2016, same as it was any previous election, I'm sure it influences price in some way, but so does it when someone sells stocks to fund a kitchen remodel or put money in because they're putting money into a 401k. So what a Biden administration means, and what Ian is saying is that we're going to just focus on price. What we're not saying is that you shouldn't, like, if whoever's watching this, they can have their opinion, meaning their personal opinion. We have our personal opinions,
right,
on who our favorite candidate was, or what a Biden administration was. I'm not saying don't have principles and values, have those things and vote on them. But for us, that has no room in a portfolio. So we're going to focus on price instead and have a plan for that going forward. And that the same applies today.
Yeah, I think that's the key takeaway, right? It doesn't matter who's in office. The data shows you can have equal returns with either party. Ian, I'm wondering though, if you'd be willing to share the personal anecdote where this election.
Yeah,
right.
Absolutely. And I did share this, and this is strictly just to prove a point, nothing more, nothing less. But I will say that the person I voted for personally in November did not win the election. And now, does that mean I should have called Dave that night or the next morning and said, listen, I'm just not real comfortable with what's going, because right, we know people did this in 2016,
right? And we know they did this time too.
And I think since election night, the S&P, as of yesterday's close, the S&P is up 14%. Our most aggressive model is up 32. Growth is up 17. So, I mean, lots of opportunity to be had coming out of November, regardless of who is sitting in the Oval Office right now. And I think that that's really just a true example of how we approach the markets and the adaptive process. And, did we have personal conversations on the side outside of, the market about politics? Of course we do. I think everyone probably does.
Yeah. But it never crossed your mind to be like, hey, we need
well,
to
and
sell
did on the Wednesday after the election, did people go into their factories and start making widgets differently? Did surgeons start doing heart surgery differently? I mean,
right.
So why would we do
anything
differently other than just follow price?
Yeah, do our process, do the adaptive process for sure.
Mm-hmm. That's one of the things I appreciate. You guys, I appreciate also the adaptive system it's price is price, data is data. You make the best moves for our clients, regardless of political philosophies, regardless of personal opinions.
Yeah.
Right. It doesn't matter what the president is, what the weather is, who your favorite team is this weekend. Doesn't matter.
Mm-hmm.
What matters is price.
Yeah, you can always talk about price. You can always talk about what team. You can always talk about your political philosophies. Hopefully we get to a point where we can do all of them just over a beer or your favorite beverage.
Yeah.
And still be friends.
Right.
Even though you're different.
Yeah.
I know you like the Chiefs. Ian, I'm Washington football team for me. Dave, I know Minnesota Vikings. So just right there, the three of us don't even align on that. We like a good game. We like good competition.
Yeah. No, to your point, Paul, I think in our country, we've gotten into a bad habit of thinking that if our opinions don't match up, that somehow we have to be mean to each other or have like these strong vitriolic responses. Whereas what if we just disagree? In fact, markets are just one big agreement and disagreement at the same time.
Yeah,
Right?
it's just people sharing their opinion. That's all price is.
That's
People
all
sharing their opinion.
Sharing their opinion, right? When two people come to an agreement on a buy and a sale, that's an agreement. But it's also a disagreement. One values it, one doesn't. And that's what makes markets beautiful. We should just be able to do the same thing, whether it's politics or football or whatever. Doesn't matter.
Right. So we've talked about leadership. I know, Ian may say the Chiefs are the NFL leadership. Some people may say the Packers, but let's get back to leadership for U.S. stocks, right? So some previous slides we saw earlier, there was data on U.S. stocks, but how they are starting to compare to emerging markets, other things. And is there kind of a shift going on, sea change? I'd like to elaborate on that. What are you guys seeing in charts? Not necessarily your feelings, but what are you seeing in charts and data, U.S. versus the world, shall we say, and how's that seemingly may play out?
Right. So like you alluded to, S&P 500 has been the best index on the planet for over a decade now. I'm not discounting the NASDAQ 100, but of the major popular ones, it's been U.S. large cap growth basically. It's been a theme for a long, long time. And I know you just scrolled to the dollar chart here. That's a major theme in what we're starting to see shift wise. Earlier in the presentation, we kind of talked about just how extreme. Ian pointed out the extremeness of February and March, and at that time, any asset manager out there seemed to be, by mid-March, was looking for anything. They were selling things, whether it was their kitchen table in their house, whether it was bonds, commodities, stocks, you name it. They were looking to get rid of it. And I know politically it's a hot item topic. It's a phrase called a reset. So while people are focused on this quote unquote reset in politics, what we saw in markets in March was what we'd like to call a major reset. From that point forward, not only have we seen dollar weakness, we've seen treasury weakness, we've seen rates rise, but even more importantly, this potential sea change that we're seeing is internationally. We're seeing international stocks, including they're buying, and no offense to anybody from Europe or, if you work for a European bank, but those have been garbage stocks for as long as I can remember, 4, 5, 6 years.
Yeah.
But now they're even buying European banks. And, I have some slides on here. We'll swing back to, but here's Japan. This is a perfect example. This is a market that has moved sideways for 30 years. And now we're making new 30-year highs. We haven't exceeded the 89 high yet, but this 30-year base that's happening in Japan, not too many people are talking about this, but these are the types of things we're seeing. Demand for Japanese equities, demand for emerging market stocks. When we look at emerging market stocks on a relative basis, they're starting to outperform the US and have been doing so since March, what we'll call the Great Reset. But in Japan, this chart's a perfect example of why you should have adaptive management in your life, right? If you're a retiree in Japan for the past 30 years, it's quite a market to have navigated, and buy and hold may not have worked for you. So for us, we'll continue to use the data. It looks like international is starting to stick as far as a relative change.
I'd say it's the best potential we've seen since 2016.
Yeah. Yep. 2016 didn't stick.
No, it lasted a couple quarters. This seems to have more breadth, more staying power,
Right.
if we want to call it that.
Yeah, more participation. When you talk about, they're just internationally, they're buying European banks and things like that, Latin America. So they're out on the risk spectrum accumulating stocks, and that's not a bearish characteristic. We'll see. Time will tell.
Speaking, you talked about currency. Let's talk about something that's, maybe not, it's gotten headlines, but it's kind of gotten buried. I'm just going to swipe back to where we were. I'd like to talk about cryptocurrencies and what the data is showing you or telling you of how we should be viewing Bitcoin or any other one in the category and what that means for our clients.
I will say that I don't know what Bitcoin or any other cryptocurrency becomes. I don't know what they're, I don't even know if they're around in 20 years. Maybe blockchain is the big thing. Maybe Bitcoin, maybe we are all, we go to the grocery store and we're buying bread with Bitcoin.
Yeah.
Maybe that's what is going on in 20 years. I have no idea. What I do know is that Bitcoin is publicly traded, and it comes with data visualization that we can make investment decisions on using our process, just like we would with an ETF or an index or a stock or interest rates. It's just data on a screen that we can use to let us know if we should own it or if we should not own it. And for some of our clients, we did get long Bitcoin back around 17,000. That was on more of a relative breakout in November. It has recently broken above the 2017 highs around, we'll call it 20,000. I don't think it technically got there, and maybe it was a couple $100 away in 2017, December 2017. So we've now moved past that. So we feel that there is potential for this trend to continue now that we are above the 2017 highs. Is it going to be smooth? Probably not.
I thought Bitcoin was low volatility.
It is not, and it was pretty funky. I know we like to talk about the big returns that we saw in the last run. A lot of that came in 2017, but really it started from a technical perspective in 2015. So we want to talk about, going from $100 to $20,000. There was a lot of heartache and restless nights getting there. So I would not expect it to be any different this time around.
And it's kind of a dollar story too.
It is.
Right,
It is. I
because-
mean, Bitcoin is priced in dollars, just like everything else. If the dollar we sell, as Dave mentioned, anything that's priced in dollars, if the dollar is worth less, it's going to take more. And so somewhat, yeah, I think you could call it like an inflation story, I guess. I'm not saying that we're not making a call that we're going to some inflationary environment and bread's going to be $19, by 2023. But I mean, it's just simple math.
Right. One divided by another, and if the dollar's falling,
Mm-hmm.
like Ian said, it takes more of it to buy something, and Bitcoin appears to be in that same environment. And as long as it's holding prior highs, that's about the most bullish thing it can do.
Yeah. So I was wondering if crypto was going to be, I use a term ubiquitous, which is maybe a little too fancy of a term, but almost like, remember Dave, or like it got like pot stocks were like, everybody's like, hey, can you give me some weed or YOLO or whatever? And all of a sudden CBD's like in gas stations.
Yeah.
And wherever you want to go, CBD sold here, right? So then everybody's on that train, shall we say, or bandwagon. And so you're right. I was also looking, hey, are we going to buy bread, a Snickers bar, or whatever you pick up at a gas station with crypto? I don't know. We don't
People
know.
are getting paid salaries in crypto.
Yeah.
People have bought food with crypto. I mean,
There was a
it's-
football player that
yeah.
requested, I think, a third of his salary
Was
be
that
paid.
Russell Okung?
Yeah,
Hopefully I'm saying his name
I
right.
think it was a third or some pretty
Right.
significant portion of his salary be paid out in Bitcoin.
And what surprised
Pretty
me is
savvy.
how people get really opinionated about that.
Yeah.
But what does it matter? That's his business.
Yeah, like,
So if he wants to get paid in that and Bitcoin's zero, that's his own problem. If he wants to get paid in that, Bitcoin's 100,000, fine.
good for him.
Yeah, like so I don't know why
Markets,
there has
baby.
to be like
Free markets.
I don't know why there has to be strong opinions about what Bitcoin is or isn't and all those things. And obviously there's some very smart people involved with it as far as what Ian alluded to with blockchain technology. Something just let
Maybe I should inquire about that.
Yeah, maybe. Yeah. I'm getting
Maybe
paid by
maybe I
client
should
first,
ask
it's a
you
big
guys
thing.
to pay out a third of my salary
Yeah.
in cryptos.
Why I think my office is so hot. I'm mining so much Bitcoin in there.
Yeah. Hey, just stay around 12 kilowatts.
That's right.
All right, here we go. So it's early 2021. Prognostication or forecast is really the topic du jour.
Yeah.
Everybody loves to make a prediction.
And so I'm not going to ask you to make a prediction. I just want to know, and clients are going to want to know, and even people listening to this are going to know, hey, how are you guys going to approach 2021? Because you just covered 2020 and all what went into that and how interesting of a year it was, both from a down and an up, like a V, we'll say, and that's gonna be written about for ages. And I thought you guys did a nice job of like what went into your decision making. How are you guys approaching 2021 and moving forward?
I think Ian said it best yesterday when we did this live, that same way we did 2020.
Yeah. And if we
One day
get
at a time.
Yeah, one day at a time. If we get to February 25th again and they start selling stocks,
That's fine. We
then
have
I
our
guess
price levels.
we're, back on. Like, I don't understand predictions. I think that immediately you're going to begin looking for confirmation biases that, like,
Yeah,
I think
humans are weird that way.
having prediction on January about what's going to be where on December 31st is,
It's a fool's errand.
yeah,
But humans love it. I mean, yesterday we talked about how humans love predictions, right? Because it makes people feel good to have a prediction like, oh, that means this is going to happen. But people never check the prediction to see whether it was true. They just love the idea that there's a prediction. So we get asked all the time, where do you think the market's going to be by the end of the year? I literally have no idea.
Yeah.
I have no idea. I don't want to marry that opinion. I married my wife. I don't need to marry my opinions. So by December 31st, whatever it is, it is. And so for people, I know that all three of us would just encourage people, don't get wrapped up in predictions. For us, we'd rather just have a plan. So approaching 2021, something like the S&P 500. We know for us in our adaptive process below 3770, on something like the S&P 500, we're going to start taking our foot off the gas. We have our price levels pre-identified. We are reacting, but the game plan is set beforehand. Much like you would in a football game. You have your game plan, you make your adjustments ongoing, and you have these levels that you're going to use. 3770, 3600, below 3200. We want nothing to do with stocks.
Right.
These are all things we know ahead of time. So it's not like we're walking into 2021 surprised.
Well, and it's like asking a coach, like, well, what call do you think the defense is on the third play of the second quarter? What play do you think the offensive coordinator is going to?
idea.
I have no idea. Like, how
Let's
many
see what
like
the
other like
circumstances are.
circumstantial like things go into that decision?
Yeah,
There's a little bit of game flow.
Yeah.
Right?
What's the environment, right? We talk about there's environmental information and then there's signal information. So environmental is what kind of environment are we in, such as 3rd and 10, third quarter, down by 7. That's environmental information that you can't have any idea when that's going to take place prior to the game. Then there's signal information. For us, signal information is price. Is it above 3770? Yes. Okay, let's participate. Those types of things. I will say environmentally, we could talk about 2021 that Ian did a good job highlighting earlier in the presentation, the put call ratio, which is just simply a math problem. It's one divided by the other. And that low ratio doesn't necessarily have to be a low put number. What it appears to be is a high call number. There's a lot of people participating, retail included, in markets, including options. So that same scenario was taking place in the late 90s, where not only were institutions involved, but retail was involved. And so when you look at like something like a Google search term, like how to trade options, once people started working from home, tons of people started trading. We're looking to trade options at home. I'm not endorsing or recommending trading options. I think that's a little bit playing with fire if you haven't done it before for a retail person. But what we're seeing is, just the other day I walked into a gas station and the clerk was talking to the other clerk about using Robinhood to buy stocks. I get texts from friends all the time about what stocks they should be buying. This is what Paul Tudor Jones, I think, and I don't want to put words in his mouth. If he ever were listening to this, that'd be awesome. Hi, Paul. But if the last third of a leg is the hardest third, and typical last third of like a major advance, everybody's involved. That's what the late 90s was. Everybody's involved. And so there's no problem with that. That's the way, like 06, 07, tons of people involved. 97 to 2000, tons of people involved. Everybody made money during that period of time. So a low put call, lots of people participating in risk things like options, being on Robinhood. These are all fine dandy things, we'll participate as long as it makes sense to participate. So environmentally, it appears that it's going to be a leg where everybody's involved, and you're going to be, maybe it already happened. Maybe you went to Christmas and your family was already talking about stocks. Ian and I think that the next few holidays with family, people are going to be talking about their best stocks.
Yeah.
That's just going to be a topic that comes up over and over. And that's indicative of the environment, this final leg that could last months to years.
Yeah, I'm glad you brought that up because I know that chart, teasingly, I said looks like a seismic graph, but what does it really mean to the, John and Sue Smith, just, name a name. And that's right. Everybody's getting involved, right? Or even like emerging markets or even like established markets, like European banks, like people are buying those when you're like, why you're just buying something just for anything. So that's where you kind of have to be careful as well for, are those the right investments for our clients? So that's why, again, that's why I appreciate the adaptive is like, just because people are buying doesn't mean we should be buying.
Yeah.
Right.
So, all right. Anything else you guys want to cover? I think we covered that put call thing at the end. I know we had some other good interactions.
Well, this chart that's up, the treasury rates chart is, it's a fascinating one because I believe Ian and I, when we've talked about this one in the past, this breakdown that happened out of this channel. So we've been in a 35-year downtrend in rates. This doesn't go on forever. We don't know when it potentially changes. But you could see 3 or 4 years here of rising rates, but yet still being a
And
downtrend.
still being in a multi-decade downtrend.
Still being a multi-decade downtrend. Now, it also could be, we look back in time and be like, oh, the great reset of March 2020 was also the reset of rates, and rates move higher continually from here. We don't know. It's just right now they're on a near-term breakout. Higher rates is environmental information. So we'll see. We'll see where rates take us, but that's kind of a big story too.
We'll keep an eye on it. So thank you, gentlemen. Dave, I'm going to turn over to you for final thoughts. I appreciate all the work you guys are doing for our clients and for everybody listening. If you have any questions for us, you guys know how to reach us with our website, our phone number, our email. So Dave, I'm going to turn over to you for final thoughts. Thanks once again, and we will see everyone either at our events or through our educational recordings. Thank you.
Thanks.
Have a great weekend, everyone.
So I hope you guys appreciated that back and forth between Paul, Ian, and myself. I want to leave you guys with some final thoughts as we close out this presentation. And one of those is not every market environment is the same. We know this, whether we've got a market where the VIX is low or an implied volatility is low and stock prices are nice and smooth. We've got other environments where it's not so smooth. We've got corrective markets. We've got sideways markets. So not all markets are the same. And that's why it's important to have a system, a process for digesting information. For us, it's the visual study of supply and demand, AKA price on a price chart. And that's how we're going to identify risk versus reward for our clients. And so we're always going to identify risk versus reward in our process. We're going to invest with the direction of the trend. We're going to manage risk using weight of evidence and position sizing and stay disciplined to the system and the hard data, because really any new position that we're taking in portfolios, it's either going to be a big win, a small win, or a small loss. Well, the aim of the system is to avoid big losses, because if we can do that over time, we can reduce volatility in the portfolio and increase returns. And so part of that process is just staying adaptive, keeping an open mind. It's what's kept us strongly invested since early November. Our clients are very familiar with that. And if we start breaking important levels to the downside, we'll keep those in mind too, and we'll manage that risk for our clients as well. It's why we remain adaptive. So with that, I appreciate you guys joining us for this. We are a full service registered investment advisor. If you're looking to secure your financial confidence, you can just simply schedule a no-fee initial consultation. Very simple. You can call us, the number here, 262-335-1700. Someone will be able to help you. You can or if you like email better, you can do that at my team at clientfirsttaxandwealth.com. From that point, you work with Client First. We customize a true holistic plan for you. We receive ongoing updates as your life changes. And through that process, through that ongoing strategy setting, you enjoy your new financial confidence. So I appreciate you guys joining us. You guys take care until we see you again, or until you watch again. Thanks.